Welcome back to Curious Commerce, a continuation from part one related to the working capital management. The definition of working capital is the excess of current asset or current liabilities. Now, let us understand this definition slowly. What are current assets? Current assets are those assets that bring cash into the business within short period. Once again, I will repeat, bring cash into the business within short period. For example, cash, bank balance, debtor, what we call as a customer who will pay, stock, bills receivable. So remember, current assets bring cash. And the same way, what are current liabilities? Current liabilities are those obligations that demand cash payment in near future. Demand cash payment in near future. For example, creditors, outstanding expenses, bills payable, short term loans, bank overdraft. So remember, current liabilities demand cash. Meaning of excess. Excess of current asset over current liability. Why excess? Because that excess amount represent safety, liquidity, and financial comfort. If your current assets are equal to current liabilities, business is just managing. If current assets are less than current liabilities, business is in danger. If the current assets are more than current liabilities, business is in a safe position. So remember, excess means safety. Now let us understand with the simple numerical example. The current assets of an organization is 4 lakh. Current liabilities of the organization is 3 lakh. We already know that the simple formula for calculate the working capital is working capital equals current asset minus current liability. So, working capital equals current asset minus current liability means 4 lakh minus 3 lakh, the working capital is 1 lakh. What does this 1 lakh mean? It means after paying all short term dues, the business still has 1 lakh as cushion. This is safety money, operating comfort. This is day to day support fund. Positive working capital indicates good short term financial position. So, dear learners, remember three golden points. Current assets bring cash, current liabilities demand cash, excess of asset over liabilities means safety. That is why we say working capital shows the short term financial health of the business. If you understand this definition properly, you have already mastered the foundation of working capital. Dear learners, we already understood what working capital is. Now the question is, why is working capital so important for a business? Why do successful companies always focus on cash flow? Now one more question, why do finance manager constantly monitor working capital? The simple answer is without working capital, even a good business will fail. Let us understand this through four powerful reasons. First one is uninterrupted production. Production means we know that raw material must come, workers must work, machines must run, goods must be produced daily. But what happens if working capital is not available? No money leads to no raw material. No raw material leads to no production. No production leads to no sales. No sales leads to no income, no profit. This is a chain reaction. A simple example, the biscuit factory needs the raw material like the flour, sugar, milk powder, packaging materials, etc. every week. The factory must purchase these items. If today the factory does not have working capital, supplier will refuse delivery, right? Machines will remain idle, idle for the duration. Workers will sit without work. Orders will be delayed. So we clearly understand working capital ensures continuous, smooth production. That's why companies always keep sufficient fund ready for the operations. The second one is meeting the short term obligation. The short term obligation means salaries for the employees, wages for the laborers, rent, electricity bill, internet bill, EMI payment, supplier payments. These payments are time bound, they cannot be postponed. Just imagine that salary delayed creates labor problem. Imagine factory delays salary by 10 days. What happens? Just imagine that. Workers become unhappy, motivation decreases in employees, productivity falls, some employees leave the job, maybe the labor unions may protest. All this happens not because the business is bad, but because cash was not managed properly. For understand purpose, the one more example. A shopkeeper delay payment to wholesaler. The next time, wholesaler refuses to give goods on credit, right? Or charges higher prices, or demand advance payment. So working capital helps businesses pay on time, avoid stress, maintain smooth operations. The third one is the goodwill. Goodwill means the reputation, the trust, and the market image. And working capital plays a huge role in building the goodwill of the organization. For example, a business that pays suppliers on time, pays salaries on time, pays bank dues regularly, clear electricity bill before due date. Such a business gets better credit facility, right? Respect in the market, priority from the suppliers, trust from the employees, confidence from the banks. Let us understand practically. Two shop owners, Ramesh and Suresh. Ramesh always pays suppliers on time, but Suresh delays payment every month. When new stock arrives in the market, supplier first inform Ramesh. Supplier gives better to Ramesh compared to the Suresh. Supplier gives the more credit to Ramesh compared to Suresh. Why? Because Ramesh has goodwill built through the good working capital management. So remember, good working capital leads to strong goodwill. The fourth one is growth and expansion. Every business want to grow, more customers, more branches, more products, and bigger and bigger markets. But growth requires money. For example, a small bakery is doing well, customers are increasing, orders are growing. Owners want to buy another oven, hire more workers, open one more outlet. But if he does not have working capital, he cannot buy extra raw material, he cannot pay to the new staff, he cannot handle larger orders. So growth opportunity is lost. That's why we say no working capital, no expansion. Many businesses fail not because demand is low, but because they cannot finance growth. This is very important real world lesson for the entrepreneurs. Let us summarize everything in simple language. Working capital helps businesses to run production without stoppage, pay salaries and bills on time, build trust and reputation, expand and grow smoothly. A business with no working capital leads to stress, delay, loss, and failure. Gross working capital leads to stability, respect, and success. Learners, always remember profit shows success on paper, but working capital shows strength in reality. Big building, big sales, big brand, all are useless if working capital is weak. That is why every smart business owner, every financial manager, every entrepreneur gives top priority to working capital management. Types of working capital, the overview. There are two types of working capital. First one is gross working capital, and the second one is net working capital. Let us discuss one by one why the classification is needed and what are the natures of the gross working capital and the net working capital. Thank you all for daily updates. Follow WhatsApp channel Curious Commerce Financial Management Hub. Working capital management continue in part third. If you like this video, like, share, and subscribe. Thank you all.